The hyper focus is really for me. I'm not saying that I will never do anything in other markets. The Tennessee Valley is fairly target rich, and I like to be 1 hour away from our deals. And one of the things that Harvard Grace does is we manage our properties. We do the property management. We could do a whole show on that. I think the property management model is broken. And so we sort of do that as a loss leader. We take a customary fee for that, but trust me, we're losing our shirts doing that. But to me, it is so important to do the boots on the ground management to deliver on the pro forma that has been sold to the investor. And that's okay. I do enjoy it. So it's not that big of a burden.
Are you looking to grow your real estate business in 2023? If so, podcast guesting may be just what you need. To learn more about podcast guesting and how it can help grow your real estate business in 2023, go to podcastingu.com/syndication to book your free discovery call. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Well, what's your philosophy on being hyper-focused on a market or hyper-focused on an asset class or not? Well, our guest today may surprise you in his thinking behind, hyper-focused on one market or numerous markets or how he thinks through the asset class. I learned a lot, and I know you are going to learn a lot today from our guest, Stewart Heath. He's the founder and CEO of Harvard Grace Capital, a private equity real estate firm that helps people build wealth faster through hands-off real estate investing that generates passive income, reduces risks, and maximizes tax efficiencies. Stewart, he's a certified public accountant and has been for over 35 years, in 35 years in real estate as well. His experience encompasses multifamily and commercial property development, construction management, and investing. Stewart elaborated on numerous pieces of their business, and I loved hearing to really the timeline of the unfortunate collapse of his real estate business early on in 2006 to 2008 during that time period. But then what he learned from that and how he's applying that moving forward, I think is crucial for you and I as we are building our real estate businesses right now, right? As the market seems to be taking a shift and lots of things happening, man, I hope you listen closely to what Stewart learned and are applying those same things. Well, I know on the show, many of you have heard many different philosophies about being focused on one market versus many markets, or one asset class versus many asset classes. Well, our guest today is an expert in just that, and he has done this, and he is hyper-focused in a market, but not so much one asset class. And so I'm looking forward to diving in, figuring out why that is, and just the thought process behind that. And so our guest today, Stewart Heath. Stewart, welcome to the show.
Whitney, thank you so much for having me. As we discussed before the show, it's quite the honor. You're well known in my circles.
I appreciate that, and honored to have you on. And so let's dive in. Give us, a brief intro, from you, Stewart, of who you are, how you got to this path, through your path of real estate. Let's do that quickly. I want to dive into your expertise, in your market and asset class.
Yeah, it's named Stewart Heath. I am from Brentwood, Tennessee, just south of Nashville. I'm a CPA and practice as a CPA for more years than I'm willing to admit on this show. Anyway, still licensed and still have a small practice, but around the year 2000, just really got heavily into rental real estate and pursued that with a passion, built up a personal residential portfolio, did some development and home building, and went upside down in the 2009 financial crisis. And then got back on my feet and started pursuing real estate. I like to think in a smarter way now. And as you said, pursuing everything primarily in a geographic area that we call the Tennessee Valley, but it's actually a little bit more focused than that.
Yeah, awesome. Well, I appreciate that. You have been in a CPA for many years, no doubt. I just feel like there's so many things in that field that helps you in our field. You have a leg up, I think, in a number of ways there. But I also want to mention, you just said, you went upside down in 2009. And would you be willing to elaborate on what that means exactly? What happened to some degree? But then you mentioned coming back now in a much smarter way. I'd like to hear just more details around that. Obviously, I want the listeners and I to be able to be doing this in a smart way, like you're referring to. So elaborate a little bit on maybe what happened in 2009, but what changed now, how you're doing real estate.
Long story short, so I bought my first duplex in 2001, a small duplex in Franklin, Tennessee in the hood. And then 9 months later, I bought a group of 14 duplexes north of Nashville. And so suddenly I was in the property management business. And along the way, purchased a property management company, mainly so I could have the staff to take care of my own properties. And from there, I started investing with a client on building homes in Williamson County, Tennessee, which is fairly well-to-do county in the country. Home building going crazy, and it still is. And so from there, I kept pursuing more and more deals. And so come along about January of 2006, and I've got almost 200 residential units under my belt. And I had acquired all of the units of one particular condominium unit in Nashville and said, all right, I'm going to flip these things. So we started out in that year. We did our planning, put our financing together. And so by the end of 2006, we were rolling in. So in January of 2007, we were going to sell some of those condo units that had been rentals, but we'd refurbished them. They looked great. I'm still proud of what we did there. And we had a grand opening and the whole bit. And I had 24 ready for market. And in our grand opening weekend, we sold 26. So I sold all those, finished them up. We closed on everything and sold 2 pre-sales. And then we just, went on with the rest of the building. Well, 2007, it was an interesting year. That's when we start to see all kinds of issues happening financially with great big financial institutions. And so I didn't sell another unit for another year. And so the market just turned and banks started changing. Up until that point, banks they were just allowing us to do anything that we wanted. We had an idea. They'd issue you credit to go and do it. I'd buy one property, have it for a year, refinance it the next year, take cash out of that one, go buy something else. And so just stair-stepped all the way up to what really became $20 million of appraised value of real estate in 2008. And then in a 90-day period, all the wheels just came off. Countrywide Mortgage didn't announced on July the 27th of '08 that they weren't funding mortgages at the end of the month. Everything just came off. So I like to say that when I pulled a financial statement for the bank on June 30th of 2008, I had a net worth based on appraisal of a little over $10 million. 90 days later, I figured that I was probably underwater $5 million because, everything had just collapsed at that point. And so then I spent the rest of 2008 and most of 2009 unwinding deals, trying to get out of deals, giving deals back to the bank, and, basically going back to zero, if you would. So I think Warren Buffett was famous for saying, now we're going to see who's been swimming without any trunks on. And debt and real estate go hand in hand. And if there is no debt, the value of your real estate is a lot less than it was. And so when the credit markets ceased lending, then all you had was a bunch of real estate and people getting laid off and nobody paying rent or half your people paying late. It was just a mess, just a complete mess. From there, I ended up having to get jobs, real jobs back in industry. I became CFO for several companies after that point and one COO position. So, had a good career since that time, but my love is still real estate. And getting back into it, I said, all right, what do I not want to do again? I said, well, I don't want to do this again without any reserves, because that's really my big lesson. I could have saved a $20 million portfolio had I had $500,000 in cash to carry things for up to 2 years. They didn't need to be carried. In hindsight, they didn't need to be carried for 2 years, maybe a year, until things started getting back to normal. But I was doing all that on debt, no reserves, and when you got to the end of your rope, there was nowhere else to go. So these days, I do syndications in all of our deals from the get-go, and I realized that diminishes my IRRs over time because you've got capital you're pulling in that you're not deploying and putting to work, but it's there if you need it, and because you don't know what's going to happen. And from there, I've also focused completely on cash flowing properties. Usually everything we bought to date is 100% occupied with good lease structures in place. Doesn't mean there's not any upside. Because there always is if you're buying a good property. But with recurring cash flow and proper reserves, and then when you do that, you do a nice, as long of a fixed interest rate as you can get, you've pretty well de-risked the asset. And to me, that's what investing is about. It's about recurring cash flow. Other stuff is what I like to classify as trading. We've all heard about day traders. You got fixers and flippers. Nothing wrong with any of that stuff. It's just a very different risk profile. If you're putting money or lending money to a fixer and flipper, that's a quick in, quick out. And to me, that's trading and it's not investing. So that might have gone beyond what you were asking.
No, that was, I wanted you to elaborate there just like you did. Because you gave a great timeline there of like, this is what happened and this is what happened. Like you bought one duplex, then all of a sudden you bought 14 more. And no doubt, all of a sudden, your life just changed, right? Your nights and weekends just got crazy.
Right? I had a property manager in the beginning for that, but that didn't last very long. So
yeah, I mean, you even bought a property management company then to manage, all these units. And it's interesting. You mentioned, in January of 06, you had 200 units. You sold 24 condos. It's like, man, this is going amazing, right? I mean, I really, at the top of the mountain there. But man, things changed quickly, right? At that point, and I just thought you mentioned there, hey, you had a net worth on paper of 10 million. Within 90 days, ultimately you were broke. I want the listeners to hear that, but also I want them to hear what you said you're doing different now, or the statement you made that you said you could have saved $20 million, or so if you had 500,000 in cash reserves.
Yep.
And so, I've been scrutinized in the past at times too for having too large reserves at times, or a couple of investors and who said, hey, that's, that hurts the returns, on the deal. And I'm like, well, maybe you're not our investor.
That's right.
Yeah. I mean, it's, however, and I would say too, the listeners have heard me talk about this before, but the worst one was as far as being scrutinized about it was we closed a week before the country shut down, in March of 2020. And you never believe when that happened, everybody's thankful we got the reserves we got, right? That was one of our best deals ever, but still, it's like, man, being able to sleep well at night means something. And so it sounds like, you unfortunately learned that lesson the hard way, but now you're able to move forward and just, you've got that like dialed in, right? That's a pillar, this is going to happen. And I love that. I want to zoom out a little bit and us go through a few things that you've mentioned in a little more detail. And, you talked about focusing on the Tennessee Valley, or that market specifically. You're honed in there. You mentioned, you're not going anywhere else. Give us some thoughts behind that. Why so hyper focused there? Why not willing to say look at some other markets or surrounding markets, or why the hyper focus on that market only?
Yeah, well, the hyper focus is really for me. I'm not saying that I will never do anything in other markets. The Tennessee Valley is fairly target rich, and I like to be 1 hour away from our deals. And one of the things that Harvard Grace does is we manage our properties. We do the property management. We could do a whole show on that. I think the property management model is broken. And so we sort of do that as a loss leader. We take a customary fee for that, but trust me, we're losing our shirts doing that. But to me, it is so important to do the boots on the ground management to deliver on the pro forma that has been sold to the investor. And that's okay. I do enjoy it. So it's not that big of a burden, but the model is broken where you can't really hire top-notch people without them basically taking on more than they can handle and make that a business itself. But the Tennessee Valley, I mean, essentially that's the Tennessee River Valley, but more specifically, and we talk about this in some of our marketing, we focus on the 840, 565 corridor. So I-840 is an interstate loop on the south side of Nashville, and you proceed south from there to 565, which is an interstate connector running through the northern Alabama. And so that is our clever way of saying that's the geographic area we're focused on. But the heartbeat of that region is Huntsville, Alabama. 10 years ago, it was a small little city, a bunch of rocket scientists and NASA based there, and everything's changed since then. And Huntsville is a dynamic city. It was about 200,000 people in 2008. Today, it's about 450,000. And this is the northern Alabama area. That's not all of Huntsville. And it's being driven by a combination of private manufacturing investment and government investment. If you're a defense contractor, you have a facility in Huntsville, Alabama. A large part of the FBI's Quantico, Virginia facilities are being relocated. They're under construction right now. I hear it's the training academy where every FBI agent will go to train. But there's other facilities the FBI is doing there as well. There is obviously expansion of NASA and expansion of the Army's footprint here. Since the Base Realignment Commission in 2008, they relocated 3 Army commands that had been elsewhere in the United States here. So we now have 3 4-star generals where there only used to be 1 2-star general. And that's, if you're in military, that's a major infrastructure change. And Facebook has a major data center here. So it just keeps coming and keeps coming. And here's the way I can sum it up. I've been in Nashville almost my entire life. Huntsville reminds me of Nashville 30 years ago.
Yeah.
So to some extent, for me, I don't see why I need to look anywhere else.
Yeah.
And I see multiple opportunities in all asset classes, but not just in Huntsville. I mean, our first deal was in Spring Hill. It is inside that 840, 565 corridor, but we bought an office building within eyeshot of the GM, what was the original Saturn manufacturing plant, but it's now the location where they're building their EV assembly plant and their EV battery plant. So just here in the sort of the central South, if you would, just lots and lots of opportunity.
Yeah, what I hear is just that, you have a long history there personally. Like you've seen this growth, the market very well. It is a good market. There's lots of growth there, lots of things happening. And so it's like, and I feel like we did this early on. It wasn't me specifically, but my business partner had lots of market knowledge in the market we were focused on and had some deal flow, and it was a great market. And so it's like, well, let's just hammer in here, focus in here, as much as we possibly can. And I think we grew really fast early on because of that. It's like we became a pretty big operator very quickly in this one market, right? And we were, known there, and brokers knew us there because we had done so many deals, or, very quickly we had proved that we could do it. And I think it helped us as opposed to, getting started brand new in numerous markets at the same time, right? We're moving into different markets now. It took some time building that track record in one market, and then we moved to another one. And now, I think we're about to go into our 4th market, but that didn't happen all at once, by any means. And so I just think there's a lot of value in being hyper-focused there, especially until you say you're hiring more people on the team that become market experts, in other markets before you dive in other places. But now you're not focused on one asset class. And I hear, different trains of thought around that. I want to hear your opinion about, we're not focused on one asset class. We're willing to do different things versus the train of thought that says, I want us to be as good at multifamily or self-storage as possible, or we're just not going to do anything else. So tell me about your philosophy behind, we're not focused on one asset class. So we're willing to do some different things.
Let me first say, I don't think anybody else is wrong. So I think it makes a lot of sense, especially if you're going to be in multiple markets, to focus on a single or 1 or 2 asset classes. Be the expert at that. I've been in property management for a while. I have had experience in a lot of different asset classes. So, our first acquisition was an office building, which frankly, I was managing for one of our clients for 4 years before we bought it. And so this was not a big leap. The funny part was all the reactions I got around the country, because we bought it in the middle of the pandemic. And it's you're buying an office building? Are you crazy? Well, no. The building is full, and let's face it, in the South, we've acted like there was no pandemic from about June 2020 forward. So everybody kept coming to the office. We didn't have a single tenant miss any rent. So to me, that takes me back to all real estate is local. What's the first rule in real estate? Location, location, location. So we've done office. We just closed a self-storage facility, and we picked a very simple self-storage facility. It's 125 big units that's all for RVs and boats. And so it's unmanned. And so we don't have a full staff there. We're not selling boxes or renting trucks or any of that kind of stuff. So it's a very simple operation. We can control the gate if we need to from our office. It's sort of a credit card business, and you're dealing with a class of people that typically own a $500,000 or more RV. So collections tend to not be an issue there. So I'm located at that facility right now because, we had a tree limb fall on a fence. And, I met the fence contractor here earlier today. We're pursuing other office. So when I say office, we're not talking about central business district office. Some people actually call the kind of office that we're pursuing as retail because they are consumer facing businesses. One of them's got a yoga studio in it. The other one is doctors and dentists and salons and stuff like that. And these are services that can never be outsourced or go remote. These are businesses that require a physical location for their patrons to come to. And we've not done multifamily yet. I'm not opposed to multifamily at all. I think it is the leader of asset classes that actually drags all the others behind. I mean, self-storage is a great way to play the multifamily movement without the toilets. And to a certain extent, suburban office, you do the same thing. You get a bunch of apartments and houses together. Well, those people are going to need doctors and dentists and state farm offices and stuff like that. So you build smaller properties. We feel like being an expert in the community makes it not so necessary for us to focus on asset class expertise. And there is such a thing as an asset class expertise. Yeah.
I like the flexibility to a big degree as well. But I think it even goes back to our first question about being hyper-focused in the market that you're in too. And so it's like, well, you're going to have a better understanding, or as you gather that data, you see growth. You're just gonna have a better feel, I think, on moving from one asset class to the other. Whether it's self-storage or whether it's that retail center, or whatever it may be. Where growth is happening, or where there's a lack of a specific asset class. That's needed. I think you might sense that better than, somebody that's not as hyper focused on one market. We hope that we're diving in a market as much as possible, but man, growing up there or being there for 30 years, I mean, you can't replace a lot of that knowledge just by going and reading, somebody's write up about a market. Right. And so right. There's a lot of value in that, to say the least. But, let's talk about, as we talk about different asset classes, you had mentioned, minimizing a lot of that risk because, they're cash flowing from day one. We say that as well. I would say the majority of our projects are cash flowing from day one. We do feel that minimizes a lot of risk, and so we're not, there's very few projects where we've had to go in, and let's say we're vacating half of it or something to complete the business plan. And unfortunately, yes, sometimes, that is necessary, but I don't personally feel like that's the least riskiest, right, of investment strategies. However, sometimes there's some big rewards that way, but it does require more risk.
Absolutely.
So maybe it's not for every investor. But talk through your philosophy a little bit on, deals that are cash flowing from day one and what you're looking for. Maybe some things that are going to break a deal, or from you all pursuing it. As far as it cash flowing from day one, and any other things that minimize risk.
When we're underwriting a deal, to me, it almost comes down like it's a piece of financial paper, if you would. It's just an income stream. And you can't do that if you've got a major development plan or a turnover plan that you have to implement. And, some of those are awesome opportunities. But as you just said, I'm doing what I like to call boring investments. All of these are mature properties. The tenants they've been in place for quite some time. There's no build out to be done. What I do like is a mature property that the biggest thing we have to do is to raise the rent, as they come due and up to market, which frankly we've been doing in the self-storage opportunity. And so that's where management can actually make a massive impact on the value of the asset without having to have any construction risk or much market risk. And we achieve that by having, I think, as I said before, fixed rate mortgages. That's been tricky. I'm sure guys. I know guys who are doing capital calls right now because they did a deal. It was probably a turnaround deal, but they had some floating rate debt. And so then we all know what happened in the last 12 months. I mean, 12 months ago, I closed a deal at 3.25 fixed for 10 years. 12 months ago. And what are they now? I say, and I tell my investors that note's now worth more than the building we bought, You know,
Yeah.
I don't think that was a bad operating on these guys who were doing the capital calls, because who saw 4% interest rate hikes coming? Anyway, that's a whole nother show. But you de-risk it by fixing the interest rates for as long as you can. We'll go 10 years where we can. 5 years is pretty normal, as you know. You buy something that's stable, so there's not a lot of turnover. The market around it is fairly stable. We're looking for high traffic count, and that is not seasonal in any way. And then at the end of the day, it comes down to the purchase price. And if we can deliver our investors a reasonable return and still have a 1.2 times debt service coverage, to us, that's a good deal. And we've seen the last 30, 45 days, some sellers coming back to reality, because we weren't able to write any deals last fall because they still wanted to sell at cap rates of 3 and 4, which nobody can finance in today's market. But we've seen some sellers get a little bit more reasonable if they're serious about selling. And so what a lot of those guys decided is that, well, I guess I'm really not a seller at that price. And so they need to wait a little while.
Yeah. Yeah, I agree. There's been a time period here where we've had to let sellers kind of come to reality a little bit, right? And us included, there's some projects, man, we should have sold maybe 2 years ago, right? Or everybody can say that now for sure, but there's a time where you got to get past the kicking yourself a little bit, where the sellers let them get over that hurdle of, man, I wish I'd have sold, to this is reality now, right?
That's right.
This is what it's going to take, and that may take a little bit of time, or it has taken some time. We've experienced that as well. I just mean, as far as being buyers, we underwrote more deals the second half of last year than we probably have since we started. No joke, increasing team members and just having more capability to underwrite deals. And man, we just couldn't make really anything work. And so we didn't hardly do any deals last year. We did some, but nothing like we had been. And so I completely relate to you, as far as that goes, but I'm hoping it's looking up in the near future, as hopefully sellers are coming back to reality a little bit. And so what about, you mentioned earlier, we'll do a few final questions here kind of quickly. But I wanted to ask you, you mentioned, as far as these properties, taking a lot of risk off the table. We talked about reserves earlier and how important that is. I always like to hear, people are saying, reserves, because we're the same way. I want some reserves in many different aspects of the business. But is there a way that you calculate that, Stewart? Is there a way that you all say, you know what, because I've heard a lot of different say, I want 1 month of expenses, or I want 6 months, or I want 12 months, or, I've heard it all over the place of expenses, in the bank at all times, or maybe there's different ways they calculate it. Is there a way that you think through that?
We typically have gone through nothing real scientific, but we want to bank 6 months of the main mortgage payment. I'll usually round that up to include all of the operating expenses, but 6 months of the outgoing requirements on a month, assuming zero income, which is an extreme assumption.
Yeah.
When you're dealing with multi-tenant properties, I mean, really, are they all going to quit paying all at the same time? No. But it's just a number. So 6 months. And I make a point. I calculate the way that's going to drag on the IRR, and I point that out to the investors on the front end. But, we're still able to deliver 10% cash on cash, even with the reserves in place. I think I'm pretty proud of that. So.
Yeah, I would be too. No, I appreciate your just willingness to stick to that, right? No matter, if investor doesn't like the IRR being brought down a little bit because of that, they need something a little more risky. Go somewhere else. Right?
That's right. I have a list of friends you can talk to.
Yeah. So, all right, a few final things. What's your best source for meeting new investors right now?
Honestly, my own network is still the best source. In our last deal, I had one of our existing, it's a 30-year-old relationship, but he brought 6 of his friends into it, which equated to almost $1 million into our last deal. So that is our best source right now. We are gearing up, and it's really our first half goal of rolling out a pretty sophisticated outreach digitally to try to generate some contacts with investors. We're supposed to turn that on in March, so we haven't seen it yet, but I've hired a lot of probably the names that to build this for us, and pretty excited about it. I shot a bunch of video for it yesterday. So
that's awesome. That is exciting. Yeah. I wanted to highlight that, that one investor, that relationship for 30 years that you mentioned that brought numerous people, it raised almost $1 million for this one project. But I think it will be neat for you to track, Stewart, over numerous projects over the next, say, 4 or 5 years, like how much that one connection brings. from those six. And then, how much do they invest over that period of time, but also the connections that they make for you. I've just seen that happen for us. And it's like, man, when you take care of these that you're already servicing, like that starts to happen and to snowball, in ways that really you didn't expect early on, And so anyway, I just think, I hope you'll track that, in some way, so you'll know that. But then how do you like to give back?
I like to give back in multiple ways. I like to find things that some of my tenants are interested in and participate in them. In one of our properties, we have a church, and even though they're building a new building, they're going to be gone by August. I like to help them. I let them break the rules a lot and use the property in ways that benefit them, and I make sure it doesn't frustrate other tenants. I myself am very active in church and in teaching. And I participate in some faith-driven groups like that. And I'm always trying to figure out a way that our properties can outshine some others sort of in the same area and point to better things.
Awesome. Stewart, grateful to have met you and had you on the show. I know our networks connect in numerous places and we know a lot of the same people. So grateful to have had you on and just hear, the willingness to be hyper-focused in a market, but not hyper-focused really on a specific asset class, your just thoughts behind that, and even, just eliminating as much risk as possible. We all say that we're about that, but when you dive in, we're not all as about it as maybe some, right? And so I just encourage investors to ask those questions of the operators you're investing with. So I'd say you can determine the amount of risk maybe that operator is willing to accept and determine if that is in alignment with your willingness to accept that much risk or not, right? And so just appreciate you bringing that to the forefront, Stewart, and your desire to eliminate as much risk as possible and showing how you've done that. Tell the listeners how they can get in touch with you and learn more about you.
Best way to get us is to go to our website, harvardgracecapital.com. You can find links to our resources there. You can find a link to book some time with me or just join our mailing list. We would love to have anybody who's interested. And I'm serious, book some time with me if you just want to talk, because I can talk real estate all day long. Appreciate you having me.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.